One of the questions being asked by investors is whether the attacks in Paris will keep the Federal Reserve from raising interest rates in December, something many have been predicting. Steve Liesman tells us what has to happen to give the central bank pause.
The gruesome attacks in Paris have called into question whether the Federal Reserve will follow through on the market's expectation of a rate hike in December. The uncertainty centers on the question of how governments will respond militarily and how markets and the economy will react. If markets see the attacks as a reason to exit risky assets like stocks and plow into risk-free assets like U.S. Treasuries and buy the dollar, it could give the Fed pause. The strength of the dollar has been a major concern for many Fed officials. As it rises, it pushes down prices for imported goods and hurts U.S. exports and manufacturing. Doves on the rate-setting Federal Market Committee could seize on another leg up in the dollar as a reason to pause.
The dollar is certainly a factor in the Fed's decision-making. So if we saw a very sharp and abrupt move in the dollar, that potentially could give the Fed pause.
So far, there have been only muted stock, currency, and bond market reactions to the Paris attacks, providing no reason to derail the December hike possibility. The economics, though, could turn out to be more important than the markets. A Fed that's concerned that European growth could weaken in the wake of the attacks would be less inclined to hike. It would fear the knock-on effects to the global and domestic economies. While the history of such terror attacks is to undermine consumer confidence, at least for a time, they tend to have little lasting economic impacts. What would be more likely to deter the Fed is large-scale military action that includes sending troops to the Middle East. Both because of the optics and the surrounding uncertainty, the Fed would seem likely to delay a hike under such circumstances. For Nightly Business Report, I'm Steve Liesman.